You and I could buy the same house at the same price and still end up with completely different monthly payments. And I've seen it happen hundreds of times. After helping over 10,000 families get into homes, the one thing that still surprises people the most is how much their credit score controls the rate they get. That single number can either save you or cost you over $100,000 in interest charges. So I'm gonna break two things down for you. First, how your credit score actually changes the rate you get. And second, how you can work with your lender to make some small adjustments to your credit that will save you a lot of money. These things are quick, usually 2 to 3 days, and they're free. It's not some paid service. So let's get right into it. I'm gonna show you how different credit scores affect both your interest rate and, because of that, your monthly payment. So there's different credit tiers when you're obtaining a mortgage, primarily on a conventional loan. So I'm gonna show you what those credit scores are and how the rate you receive affects the payment that comes along with it. All right, so we're gonna focus on credit score and how that affects your payment and your interest rate. So just for reference, credit score. Now, I recommend writing this down or at least saving this video to go back to later so you can revisit where you think your score is. Once you know what your score is, you can see how that would affect your interest rate and payment directly. So what we're gonna use to run these numbers is we're gonna use a $500,000 loan amount. Now, this pertains to any loan amount. So I'm just using that as our number for this example. It could be $700,000, it could be $200,000. It makes no difference. It's going to impact the payment and the rate regardless. Your credit score is the biggest driver, not the amount you're spending for the property or the amount you're borrowing. So I'm gonna put this here. $500,000 is a loan amount in this example. So first, we're gonna start at the bottom, right? We're gonna say the lowest credit score. So the lowest tier is technically 639 or below. I'm not gonna go quite that low with it. I'm gonna use a 640 credit score for our example. So we use a 640 credit score, and what we're gonna show you is what a 30-year interest rate would be based on this credit score. Now just keep in mind, interest rates could vary. This is where rates are at this moment while we're filming this video. It's gonna be completely different, most likely, once you go to purchase a home. But just for this example, I'm gonna use these numbers. You will still see the same difference between interest rate from credit score to credit score. Maybe not the exact rates I'm showing you though. So these are 30-year rates. The rate on 640 credit would be a 7.25% interest rate, and the principal and interest payment, remember $500,000 loan amount, principal and interest payment at 7.25 over 30 years would be $3,410. Now, the next credit score I'm gonna show you is what I'd call middle of the road. That's gonna be a 700 credit score. So at a 700 credit score, your rate's actually be a little bit better because that's a big jump. 60 points is a big jump from that 640 we were using. So the interest rate would be 6.75%. That's a 0.5% better. But what more important than that is not necessarily the rate. You're concerned with what your payment is every month. So how does that impact the payment? Well, the principal and interest payment on the same $500,000 is $3,243 per month. Almost a $200 difference in monthly payment over 60 points in credit score. That's pretty substantial. $2,400 a year. Think about over 30 years, almost $75,000 over a 30-year mortgage, just for having 60 more points in your credit score. But what if your credit was top tier, 760 or above? Some of you might already be there. Others are aspiring to be there. That interest rate drops another 0.5% to 6.25%. When you see interest rates advertised online, this is what they're advertised based around. No one's advertising interest rates for someone with a 640 credit score. So if you're there, you want to work on your credit and improve it, because what you're seeing online or on TV is not going to be the rate that you're actually going to receive. That's a full percent difference between a 640 credit score and a 760 credit score. Takes a lot to be here, right? You're making your payments on time. You don't have collections on your credit, but this is where you should aspire to be, because the better your credit, the lower your rate's going to be, right? Lower risk because of higher credit, lower rate. Pretty simple. We're 6.25, full percent lower than this lowest tier we use, 640. The monthly payment goes to $3,078. Look at the difference in payment there. That's about $330 difference in monthly payment. That is substantial. That's like $4,000 a year less just for having your bills paid on time and having excellent credit. $120,000 over 30 years. So just for having a lower credit score, technically you're paying $120,000 extra for the same home. Just think about that. The same home. So if this home, let's call it $550,000, that's like 20% more for the same house, which is absolutely crazy. So work on your credit if you're concerned with interest rates, because the better that your credit is, the better that your interest rate's going to be. Very, very important. So it's extremely important that you're making your payments on your bills on time. You might be saying to yourself right now, well, how do I get to that 760 credit score? I'm gonna give you a couple quick pointers on that. For one, if you want the best credit score, you need to make sure you're paying your bills on time. You need to make sure you're not maxed out on your credit cards. What I mean by that is that you really want to keep your balance on your credit cards at 10% of the limit. So if you have a $10,000 limit on a credit card, you want to keep your balance at $1,000 or below. You want to make sure you're checking your credit often. The best website that I think you can check your credit on to get the most accurate scores is myfico.com. I have no affiliation with them, but you can actually go on there and you can look at the exact types of credit you want to apply for so you know the scores are accurate. Because you might hear, oh, I went to have my mortgage credit pulled and the score was 100 points lower than what I saw on Credit Karma. Well, that's because there's different types of scores and scoring models that are used between getting a mortgage, getting a car, getting a regular loan. So if you go on myfico.com, you can actually say, I'm applying for a mortgage. It will tell you what your 3 credit scores are. And that's important too. You have 3 credit scores: Experian, Equifax, and TransUnion. For mortgages, we take the middle of the 3. So you may have a 600 low score, a 700 high score, and a 680 middle score. The 680 is what we would use, or any lender for that matter, would use to qualify you. But what's cool about MyFICO is you could run different scenarios to see how to improve your score. So this way it's not a guessing game. You can say, okay, what if I pay this balance down on this credit card? How much does my score change? What if I get this collection removed? How much does my score change? But that's gonna make a big difference. And that's important to know, because I'm gonna show you what the different credit tiers are for a mortgage so you know where you're targeting. Because I just showed you a few examples, but there's actually way more tiers than what you see here. And by tiers, I mean the increments in which the credit needs to move to get the better interest rates. And the way it works is it works in 20-point increments. And I'm gonna show you that right now. All right, so credit score, and we're gonna focus on tiers. Now you may have TARS tiers if your credit's low when you see that high interest rate, so just be careful. So we're gonna look at credit tiers. They work in 20-point increments. I'm gonna put a note here, 20 points. So we're gonna start with the lowest credit tier. The lowest credit tier, this is specifically for conventional mortgages right now. If you want details on FHA, watch my video on FHA mortgages. It's a little more lenient when it comes to credit score. What I would tell you is if you're in these bottom tiers, I would say anything below 680, you probably wanna lean toward an FHA loan if it's a primary residence. But I wanna still show you the examples of what these tiers are. So the lowest tier is gonna be 639 or below. The next tier, in these 20-point increments like we talked about, is gonna be 640 to 659. From there, we go 660 to 679, then 680 to 699. Look, I almost, man, you think I do math for a living. I somehow messing that up. Then you go from 700 to 719. There's a lot of tiers I told you, I'm having to kneel down now. To 739, I'm gonna bring it up here. We'll go 740 to 759, 760 plus. Now, some lenders will be at 780 plus, and there'll be a tier from 760 to 779. In reality, you're gonna get the same rate at a 760 that you're gonna get at an 800. So just keep that in mind. But look how many tiers there are. Up until April of 2023, this was top tier. It's changed. So your 740 is no longer top tier credit. You may think, I have 740 credit. Well, that's great. It's not bad credit. It's not the best credit. You want the best rate, you need the best credit. 760 plus. So how do you get there? What I said, you pay your bills on time. You make sure you don't have collections. Because these movements in the interest rate could make a substantial difference, as you already saw, in your monthly payment caused by the higher interest rate you receive at the lower credit tiers. That's how important credit is when you're qualifying to buy a mortgage. Your credit, your income, your employment, and your assets. That's what lenders look at. Credit being number one. Because if you don't meet this minimum requirement, you don't even qualify for a mortgage, right? That's step one. So work on your credit. Whether you're looking to buy today or you're looking to buy in 2 years, put yourself in a position where you can be in the strongest possible position, I should say, to be able to get the best terms. Because people talk about affordability in housing and, oh, homes aren't affordable because their rates are so high. Well, how do you get yourself the lower rate? How do you fight that? Having better credit helps you fight that. Because although the market rates are higher, you can get a below market interest rate or a much lower interest rate just by having better credit. Really, you have the power to get the lower interest rate. Not the Fed, not me, you. I don't determine that. You determine that. So it's important that you pay your bills on time. I can't say it enough. That you don't have collections. You don't max out your debt. Don't co-sign for someone who you know doesn't pay their bills. That would affect you too. It's very, very important. And if you have questions on exactly what you need to do, or you want to speak to someone who can walk you through the process, give you proper guidance on what you need to do. If you can't help kind of figure it out yourself, maybe you listen to my advice, you go on my FICO, you still can't figure it out, make sure to leave a comment below. I'm going to reach out to you, answer your questions, help provide the guidance you need to take the steps toward home ownership, especially if your credit is the biggest hurdle you're running into.